Good afternoon, everyone. You're all very welcome to the Alpha Capital Group weekly roundup in terms of us assessing the price action over the last couple of days in the markets and I suppose evaluating all of the movements in the different asset classes accordingly. Now, of course, the last 3 days or so in the markets has had incredible volatility. We've had the Fed on Wednesday, we've had the Bank of England on Thursday, and of course, we've had the NFP yesterday in the US. Along with a lot of other different pieces of economic data this week. So there's been a lot of talking points this week. There's been a lot of fundamental movements, and there's been a lot of volatility in the markets, both up and down in all of the primary asset classes. Okay. So I suppose if we start from the Fed on Wednesday, of course, the Fed, in line with expectation, increased the rates from 3.25% to 4%, bringing their interest rate increases again in sync for the fourth consecutive 75 basis point increase in this rate hike cycle market. Now, of course, where does that leave us? Well, that leaves us now with a 4% target rate. The expectation now is very much starting to go from an aggressive hiking cycle to more moderate hiking cycle as we approach where the Fed perceives it to be the latter end of its rate increases. Now, of course, we are currently sitting at 4%, of which we have all seen 4% in increases in total increases this year. Now, I suppose if we forecast to where the Fed is looking to end, the consensus is currently that the Fed is looking to end its increasing rate somewhere near kind of 4.5%, 4.75%, with the potential to hit 5% mid next year through kind of March, April time, if it's a case that the inflation narrative, the PCE narrative, and the overall price stability aspect doesn't come down faster than people are expecting. Okay. So what does that mean in a nutshell? So what that means in a nutshell is that the expectation for December is that we see another 50 basis points or 0.5% increase by the Fed. And the expectation that we're probably going to follow it up with at least 25 in February. So 25 basis points in February, and a further potential 25 basis points in March. And I think that's really where the Fed is kind of looking at now between, let's say, November, December, and the end of Q1 2023. So the ideal terminal rate at this moment in time, according to forecast this week, sees the Fed having its interest rate very, very close to 5%. And that will be really the interesting area to see where the markets are obviously going to extend into Q1 2023. Now, over the last few weeks, you'll have seen it in the media, I'm sure, by different agencies, whether it's Bloomberg, whether it's CNBC or Wall Street Journal, you'll have heard the idea of this pivot. So for those who don't know, a pivot is effectively a change in policy stance where they opt or go from a hawkish approach in the markets or hawkish bias or viewpoint to a dovish. So that's obviously meaning where it's a change in sentiment or a change in directional bias. Now, of course, as we look at the markets on Wednesday, Fed Chair Powell, as he stepped on the stage at 6:30 on Wednesday night, he basically shut down all, I suppose, ideas of a pivot. Okay, he did say that, look, the cycle increases will slow down, and that's something that's been factored into the pricing of the asset classes, but they are still very much content in terms of getting to grips with this inflation narrative, in terms of destroying this 8% inflation target that we're effectively seeing month on month over the last couple of months in the US economy. So where does that leave us then? Of course, as the Fed continues to increase its interest rates, that helps to only curtail the increases in PCE. Okay, it only helps to curtail the increases in CPI and bring those levels to a more moderate level, and of course allowing the Fed to control that. Now, the expectation from Fed Chair Powell the other night, he did say growth was going to slow down. He did also say the unemployment levels would tick up. So generally speaking, higher unemployment levels, lower consistent growth levels will generally mean the idea of a recession. Okay, and of course, if you looked at Goldman Sachs or any other institution, you would have seen over the last 6 to 9 months that they're all pricing in recession between now and the back end of next year. Okay, so what Powell is trying to do there is effectively get the markets ready for this recession, see where the stock markets ultimately bottom out, because we know, traditionally speaking, in recessions, the stock market bottom generally comes in about 6 to 9 months before a recession, which would indicate the idea that we could be maybe not at the bottom, but starting to come close to it. Okay, and that'll be something worth keeping an eye on over the next, let's say, 8 weeks until we hit the end of the calendar year 2022. Of course, in 3 weeks' time, we do have midterm elections. And then after that, then, of course, we're into a new financial year. And of course, if you were to look at previous biases and previous and midterm elections, you would actually note on average that the stock markets actually increase between 10 and 15% after the back of every midterm election. So the midterm election is nearly like the bottom in the cycle before the actual visible bullish trend, I suppose, resumes. Now, of course, if you look at any of the primary earnings seasons that we've seen over the last week or so in terms of any of the stocks, you would see that a lot of them have disappointed, right? And you only have to look at the Nasdaq to reinforce that view, because a lot of the tech stocks have been struggling, okay? And if you factor in the additional news with the likes of Twitter on Musk's takeover, that Twitter is cutting 3,700 jobs, it doesn't bode well for the tech sector broadly. And that is, of course, why the Nasdaq, which we'll look at now in a few minutes, is lagging in comparison to its counterparts. And of course, we saw that very, very visibly this week. Now, as our attention turns from the Fed on Wednesday to the Bank of England on Thursday, we saw the Bank of England follow up with the ECB last week and the Fed this week with a 75 basis point increase. So they too increased their interest rates for the 9th time now in this cycle to 3%. So they traditionally were doing 25s, and then over the last couple of rate increase meetings, or couple of interest rate meetings, they've increased by 50 and 75 basis points collectively. Now, what does that mean now is they're becoming a little bit more aggressive. They're a little bit more hawkish. And of course, if you listen to Governor Bailey or his deputies in terms of Ben Broadbent, it's basically all simulating the same viewpoint. And of course, one of the big takeaways by the Bank of England on Thursday, for those who are following closely, is that the Bank of England is expecting one of the longest run recessions in history. Okay, they know things are ugly. They know the gilt markets is obviously continuing to progress higher, which is obviously not a good thing for government debt. But it's also a case of putting a plan in place, not just for the next 2 years, but a modest recovery. Okay, so we saw the COVID collapse, we saw the liquidity pump through, which in essence was effectively too much liquidity, because it's now caused this massive storm, which is now currently brewing in the UK market. So of course, how is that going to affect the dynamics? Now, within the UK, within the Eurozone, it's a slightly different dynamic because of the association of increasing diesel, natural gas and oil prices. And of course, as we come into the winter, that only makes things harder. So you've also got that to contend with in the back of the Russia-Ukraine war, because the USA and the US markets is broadly quite distanced from Europe in that respect, and they have their own supply lines. It makes them a little bit less in tune to the volatility associated to natural gas and oil markets. So it's also important to be aware of that. Now, broadly speaking, after the Bank of England have raised their increase rates, that then signals that they're still quite aggressive in their approach. They're saying that there's still a lot to be done. They're still expecting more increases. And of course, that'll probably mean them going kind of 50 to 75 basis points, probably for the next couple of meetings, until it catches up to the Fed. So I think the idea of the Bank of England now will see their interest rate going somewhere between kind of 4.5 to 4.75%. Now that means that they have still another 1.5 to 1.75% left to increase to get close to that target. So you're expecting really a couple of more very, very hawkish movements by the Bank of England to kind of get in line and get in line very, very quickly. Now, what does that mean for the cable? Well, generally speaking, the stronger the interest rates go, or the more aggressive the central bank is, the stronger the currency is. And of course, what have we seen since the September flash crash in the pound against all of its counterparts, we have seen a fairly modest recovery over the last 6-7 weeks in the pound. So we've gone from kind of 104, 105, 106 lows all the way back into kind of 114, 115, 116, which is an incredible move in what is a fairly short period of time for the markets. Okay, so that kind of rounds up the Bank of England. Next kind of key talking point, of course, is yesterday we had job numbers in the US. And of course, for those who are day trading any of the US based assets yesterday, we had a wall of volatility. Every 15 to 30 minutes, the sentiment was nearly changing because of market orders, because of the volatility traditionally associated to NFP, and of course, because of the mixed results. Now, if you look at yesterday's NFP figures, broadly speaking, if we just get to that, the first kind of key takeaway was that the the non-farm payroll figure was 263,000. So broadly speaking, what does that actually mean for the markets? Well, what that means for the markets is that the job numbers, broadly speaking, in terms of the number of positions being created every month, is actually still quite positive. However, okay, when you look at some of the other pieces of data, more broadly speaking, the unemployment rate and even the average early earnings, and of course the wage inflation aspect, that was quite a different story. Okay, now if I just show you the second economic calendar here that I'm currently looking at, which gives us a little bit more information, you can see here on Friday we had the unemployment rate ticking up. So generally speaking, that's again in line with what Fed Chair Powell had said regarding the increase in the unemployment rate. So broadly speaking, even though job numbers, there's still 260,000 jobs being created, the unemployment rate is starting to tick up, which again shows the fragility. Although the labour market is still fairly consistent overall at 3.75%, that is still very, very close to full employment. They are expecting that narrative to change, as I said, over the next 12 months. And of course, if you look at the labour participation rate, it is narrowly down. So that's the population, the percentage population of the economy, which is in employment. It's marginally lower compared to last month. And of course, the wage inflation now is starting to come down as well. So although the overall inflation, so that might give us a clue for next Thursday's CPI print, with the wage inflation coming down, will that now reciprocate back into the headline CPI print and the PCE print coming in now over the next couple of weeks? Well, in that regard, it'll be just a case of watching those figures very, very closely. All right. So that's kind of where we are over the last kind of 2-3 days. Okay. Markets are still very, very volatile, as you know. From a short-term trading perspective, from a daily trading perspective, markets are still incredibly volatile. So it is important to understand the nuances behind the market. I do think, right, you can trade smart money, you can trade the institutional order levels and the order blocks and the liquidity. I do agree, and I utilize that trading strategy myself. But from a longer term perspective, from a longer term bias, and particularly if you have also secondary investments in the background, it is very, very useful to understand what's going on. So at least that way then you can prepare. And when you can prepare, you're creating the best possible chance of success and profitability for yourself. And that is ultimately the longer run goal for you. Okay. Now, as we go from, I suppose, the fundamentals across to the price action, let's look at, I suppose, the mechanics and the broader market movements this week. Okay, so first things first, we're looking at the dollar. Okay, and the dollar has, we've talked about this Fed pivot for the last couple of weeks and the idea of, is there a potential buy the rumor, sell the fact? And that's exactly what actually kind of played out. Through kind of Wednesday, Thursday, Friday, we had that Fed pivot. Fed's going to pivot X, Y, and Z from all of these news outlets. And of course, what happened? It didn't quite happen. Okay, the Fed absolutely ramped through. We got back into this 113 level on the index. Now, of course, Halloween did promote the idea of creating market highs, and we saw that effectively on Thursday. We saw it again, the reaction on Wednesday with that bullish move off the back of the FOMC. Now, when you look at the broader daily trend on the DXY, I suppose the first clear observation is that, yes, for the last 4 to 5 months, we've been consistently turning higher. We've had consistently that bullish trend playing out, constant new highs, constant pullbacks, constant new highs. So the broader narrative, when you factor in the broader perspective, was of safety, was of risk orientation, out of risk assets like your stocks, like your indices, like your cryptos, into safer asset classes. And of course, what's happened since then? The S&Ps, the main indexes in the stock markets have continued to move lower. And of course, the dollar has continued to churn higher. Now, over the last couple of weeks or so, we have actually started seeing a migration and a shift between both sentiments on a short-term intraday basis. So you can kind of see the short-term pullbacks followed by risk aggression, short-term pullbacks followed by risk aggression. And then, of course, then you're seeing obviously the dollar sell-off. So we had that initial movement higher into this 4-hour order block, and this was a very, very clean level that I was looking at this week. 4-hour area of interest here at 113, very, very clear rejection, and then the fundamental news drove the price action into it on Wednesday. And of course, we got that order block rejection, and of course, with the NFP figure was again the catalyst for the next wave sell-off. So you generally have the order blocks fulfilling the liquidity moves in the back end, and then your news is the catalyst to either drive the movement of price into the level or away from the level. And that's exactly what we've seen. Okay. So from that point of view, we've seen a very, very topsy-turvy kind of week in price action, because 1 minute we're seeing bullish dollar, we get to the order block level, we get to the liquidity level, and then the markets are rolling back from it. Okay, and that is something that's been very, very clear and obvious this week. So now the current trend really is a case of, can we break the Wednesday lows in terms of the price action? And if so, then that allows for a continuation probably in short-term dollar weakness, okay? And if that continues to play out, the likelihood is that, right, if you look at the last, let's say, month of price action or so, we've created initial lows, we've created a secondary set of lows, and now the bias is, can we continue this shorter-term, I suppose, bear flag scenario that the retail traders would be looking at in terms of, well, I don't use trend lines personally, but this kind of structured kind of pullback, okay? From a technical nature, for those who trade technicals, you would see a kind of the price action pulling back. Now, at this moment in time, that does look to be the favorite price action, but when you look at the liquidity perspective as well, it's all about finding or fine-tuning those opportunities to allow that price action to develop. Now, at this moment in time, I would be really kind of reluctant to say that the dollar is going to rally again, because at this moment in time, it does look like we're going to see a shift to the downside again. So from my perspective, it'll be a case of, can we make new short-term lows in the dollar, which will again give a little bit more optimism to the stock markets into the mid-November or third week of November midterm elections as well. I suppose that's now where the price action is gearing towards now, from an institutional perspective, which prices is forward looking and is pricing ahead of time in that regard. All right, so that's where we are on the DXY. If we look at the Treasury yields, again, a very, very similar scenario. So this is another safe haven or safety asset. We've seen obviously the dollar tick up. We've seen the yields tick up. We're now starting to see a little bit of a peak again around about this 4.25 area of interest. Now, my perspective here is really just determined upon how does the markets react in this region. So we've had that initial move. We've had the mitigation of order blocks, but you can also see here we've got a secondary level, which is now being mitigated here at 4.215%. So I suppose into the early parts of this week, as we open up on Sunday night into Monday, as the clocks now normalize in the US and the clocks go back, now as we look to the 2:30 p.m. open on Monday in the US session, from a cash price perspective, I suppose all eyes is to see, do we get that continuation in dollar strength, which we've seen over the last number of months, or are we going to get that pivot of weakness in the dollar, in terms of the Treasury yields, and seeing those risk assets prosper in the early parts of this week? And I suppose that's going to be the key fulcrum point to keep an eye out on, particularly given that the dollar has sold off into this week's close. And I suppose from my perspective, that would be kind of one of the most important aspects to be looking at. Now, if we look at kind of 3 or 4 of the FX currencies, first of all, I suppose the key element here is when I look at euro dollar, just from a kind of a 4-hour perspective, you can kind of see how the markets has been creating traditionally lower highs, lower lows. So you can kind of see here a broader daily trend is bearish. We have, I suppose, a lower low consolidation period here. We've got a little bit of a pullback, and then the markets has moved lower again. Now, since those lows at the back end of September, the euro dollar has actually been trending higher. So you can see here, right, if you isolate just the price action from the 26th of September to present day, what we're actually seeing is short-term highs, short-term lows, short-term highs, short-term lows again. So when I look at euro dollar, I can still see that this level up here at 101.277, where this selling bias initiated from in the middle of September, has yet to still get mitigated. So when you're looking at an unmitigated or unfulfilled area of liquidity and price, generally speaking, over time, it might necessarily happen in the next week, but the likelihood is it will get back to test those levels sometime in the future. So when you look at that narrative, you can see very, very clearly that we are creating short-term highs, we are creating pullbacks, we are creating new highs again. And of course, what we've seen this week is this very, very sharp sell-off back into this liquidity region down here between 97 and 97.50, and a very, very strong rally back up into this region. Now, of course, if the dollar continues to weaken, which is a very strong possibility this week, you would be looking for the price action to continue higher, and you would be looking for a return to these current highs from last week or the end of October, and of course the potential to run into this liquidity area up here at 101.277. So when you isolate the price action further on the 1-hour chart, the clear observation that I've been seeing is, right, we've got the consolidation. This was the CPI stop hunt, the manipulation, the taking of lows, taking of highs, flags back down, and we're seeing the true trend originate. We're seeing the true buy-in trend, right? We're getting highs, we're getting pullbacks into this area of liquidity, and then the markets are continuing to churn higher, which we've seen into the end of October. Now, obviously, the corrective move this week was borne about by the FOMC. So this FOMC exaggerated selling from this 99.50 saw us go to 97.50. And then, of course, the weaker movement yesterday has seen us recover back into this region. So from an intraday perspective, a lot of volatility, a lot of chop in these markets, and we're seeing that very, very clearly. And you only have to look at the fact that the price action has returned almost, not exactly to the area of interest here at 97.20, 97.10, but broadly speaking, if you're looking at this order block level here, this area has been mitigated. So this 1 hour chart, which symbolizes this bullish impulse, which was the beginning or the origins of this phase of price action, all of this bullish price action has now been mitigated as the price action has come back to this region, held the appropriate level, and of course, we got that rapid breakout yesterday back into the upside. Now, of course, if you were to look at a 15-minute chart, you can actually see here, even from a shorter term perspective, we've shown that we're in consolidation. We've broken structure to the upside. We've got that wick rejection all the way back down into this area of interest down here where we've reacted from at 97.50, 97.55. And we have seen a very, very clear buying bias into the end of the week, back into those wick highs that we saw from Wednesday's FOMC. So now what we're actually seeing is into the close of the week, markets are closing at or very close to the highs of the liquidity that we saw from Wednesday evening on the FOMC wick rejection highs. So we saw that sharp volatility on Wednesday. Markets are now returning to the level to clean out the liquidity. So from that perspective now, I suppose all eyes is going to be on Monday, whether we continue churning higher, we continue to see that dollar weakness that we saw into Friday's close, and can we see that market continue to move higher? And I suppose that's going to be the interesting question. If not, it's going to be a case of waiting for relevant pullbacks in the dollar to spot the next phase higher, because of course we are now in a corrective phase. And I suppose now when you look at it, you can kind of see there's an area of liquidity here. There's a secondary level here, which obviously took this short-term high out. And now it's a case of seeing how does the markets develop in this region, of course. Okay, so that's where we are on euro dollar. So if we look at cable now, very, very quickly, again, very, very similar scenario on cable. So whether you are long cable or short cable over the last week or so, it doesn't really matter because you're getting the volatility on both sides. So the broader trend was obviously selling. If you look at, let's say, the daily chart or the 4-hour chart in price action over the last number of weeks, and of course, since that September low that we talked about at the beginning, we've actually seen the cable rally. And of course, with the interest rates increasing in the US or the UK more aggressively than we would expect the UK, let me rephrase that. If we see the interest rates in the UK being a lot more aggressive in their hiking over the next 6 months, that could actually give the pound a little bit of a rally against the dollar and see us return back into this kind of 116, 120 level. Now, when I look at the price action specifically, again, similar to the euro, after that collapse, we've seen short-term highs, we've seen short-term lows, we've seen new highs again. We're creating this bullish, the illusion of bullish trend into some of these daily rejected order blocks. We've got a 4-hour order block here at 116.880, but we also have a price action structure level up here around this, I suppose, 118 level, 118.50 level. There's a bit of liquidity still to grab up there. So it really just becomes a case of, if we see this pound continue to strengthen, then you're looking at moves back into 116, you're looking at moves back into 118, and you could see actually the price action going back into 120 by potentially the end of the year. Particularly, again, as I said, if the Bank of England follows up in December with another 75 basis point increase and the Fed's only going 50, that's going to leave the pound at this moment in time, on the short-term perspective, actually stronger than the dollar. So then it just becomes a case of mitigating out of those short-term movements of price action from risk aggression or risk on to risk safety and risk off. So it's just about being aware of that as well. All right. Now, with that aside, when you look at the 1-hour chart, we can actually see very, very clearly that, right, we've had this area of interest. We've had that massive run up. Price actions come back down. You can actually see we've actually mitigated this, the origins of this buying impulse, but we haven't actually fulfilled a whole lot yet. So this 1-hour area down here at 110 is unmitigated. So there is that downside risk. But if you look at the price action, broadly speaking, we've had that massive run up all the way up to this 116 level. We've sold off last week. So you can see how the selling bias, short-term selling bias, we've got that, I suppose, break of structure. Price actions broke through. We've actually got a double break of structure because you've got one here, we've broken through, we've flagged back up, but then you have the broader one here as well, where we've broken this low, we've flagged down, we've got this double confirmation of this liquidity area here, And then we've just melted off from 115.50 all the way back down to 111.50. So you can kind of see how there was two areas of interest there on the highs on cable. Now, if you're looking at cable, you can see there's a reaction here off 11.50, which doesn't fully mitigate this level. So again, this 1 hour area of interest, just kind of keep an eye on that. I still have this level identified on my charts. So from my perspective, again, given that we've seen that kind of 1 hour rally, it really just does depend on how the dollar opens up in the early parts of this week. We're looking at on the euro dollar. We're also looking at it on cable. And of course, if I skim through quickly the Aussie or the Aussie dollar USD, you can see a very, very similar scenario. So what happened there, the USDCAD has come back up into this region. So this structure area of here has now effectively been broken. So you can kind of see in that there now. Retail traders would see that as a head and shoulders because you've got left shoulder, you've got your head, you've got your right shoulder. You're back into a liquidity area up here around 137.75, 138. Clear rejection here. And the markets have ultimately unwinded and broken the structure. So now it becomes a case of, while the dollar is starting to correct a little bit, oil prices are seen to be slightly surging over the last 2-3 weeks or so. So that'll be an interesting dynamic because, of course, if we see stronger oil, that generally means stronger Canadian dollar. If we see a slowing down and increase in interest rates by the USD, could that lead to a short-term shift in sentiment here in dollar CAD, given that we've got all the way back up to 139? Absolutely, there is the potential for that. And when you look at the broader trend, is it completely impossible to see a short-term pullback, maybe back into this 129, 130 level down here? Well, you can see that already. We've sold off from the peak highs of 139.50 to 134. We're off over 400 points. Okay, so is it possible for the price action to sell off another 400 or 500 points back into this region? Absolutely not. Okay, and I suppose it just really depends on the price action. But even when you look at the daily time from there, there is obviously 4 hour level here at 129. There's also the daily level up here at 130, and that would be kind of the interesting point over the next few weeks if the dollar CAD can pull back into that corrective level of interest. And that is something that I'm looking at as well on this one. Okay, now last but not least, Aussie USD, before we move quickly to the indices and gold to wrap up this weekly call. You can see very, very clearly again, if you look at the Aussie USD, you can kind of see, well, structurally speaking, what have we seen? We've seen consolidation. We've seen the inputs to the upside. We've flagged back down, haven't quite mitigated this 4 hour level, but we have come very close to it at 62.80. So it won't always fill the level. So sometimes it'll do the imbalance structure, which will come into the area. Sometimes it'll fill it exactly to the region. And of course, that's why I would use a simple structure like Fibonacci's to develop and to recognize how deep the retracement is. And of course, when you look at this now, you can see that we've got the peak high. We've pulled back all the way into a discount zone, so 707 to 786. And we've seen a very, very strong reaction from this region. So although we haven't filled the order block, we have come into a very, very nice discounted buying zone here, as I said, between these two levels. And of course, if you ever want to know why 00707 is inputted, 0707 as a Fibonacci point is actually the square of 61.8 and 786. So it's a nice midpoint differential between the two aspects for those who are wondering. Okay. Now, with that as well, what have we seen? So if we move the Fibonacci's just for a moment, you will also see that the price action has returned back up into this liquidity level. So this selling trend of price action, you can see here from October. So the beginning of October into the lows has mitigated fully the highs. So we've sold off from here. We've returned all the way back into this level. We've rejected this level of interest here between 65.10 and 65.22, and we've sold off very, very clearly. So you can actually see here, we've that flagging structure. We've broken the short-term structure again. We've obviously sold off back into this corrective zone down here, and then we've seen the markets rally again all the way back into this order block. So this short-term peak high from the end of October at 64.80, this 4 hour order block has now been mitigated both on Wednesday by the FOMC, and of course the sharp sell-off in the dollar into this week's close off the back of the NFP catalyst. Okay, now where does that leave us this week again with the Aussie? Well, it just really depends on how the Aussie is going to react, because we've come into this level at 64.80, and you'll notice how we haven't closed above it. Okay, which is a fairly interesting point considering that how aggressive this buying was at the close, and it just merely stopped at this 4 hour order block. So from my perspective, this 64.80 to 65 level is worth keeping close eye attention on into this week to see if there is a propulsion through that level. If there is, we should see that weaker dollar narrative continue, and then you'll see the risk orientation of higher indices, higher Aussie, higher euro probably continue off the back of the weaker dollar. So it really just kind of depends on that. All right. Now, the last couple of things, we're going to try and speed this up as quick as we can. looking at the gold prices, you can actually see here how the gold now has formed this structured low. So we've had order block sell off back into the order block region, back into these local lows. We've tried to break through. So you'll notice here how the price action has ultimately tried to break through this, what I would like to call a point of interest. So you can kind of see here, markets has come into this region. We've tried to break through 1615 to 1620. We've rejected it once, we've rejected it twice, and we've rejected it a third time on Friday before we had that massive move higher again. Now, short-term perspective, you'll notice on the last week or so, since the last 2.5 weeks or so since the CPI data, we had that impulse, we had that break structure, we had the flagging back up, we had the mitigation over here in the end or the last week of October. And of course, then this week, the price action has rallied again back into this region and is now trying to take out this short-term peak here. So I suppose if the price action is breaking through 1685, that is now price action cleaning out this liquidity area here. And of course, taking out the wick highs, which is effectively simulating a potential change in sentiment. So from my perspective now, it really just becomes a case of, can the price action break through this level here into the early parts of this week above 1685? And of course, if it does, then is there a potential then for the price action on gold to then start ranging where we've had rejection, lows, and price action now is just reacting off price action levels and coming back in to fill the fair value sell-off that we saw from the early parts of October and return back into this 1720 region. And of course, from my perspective, if I'm looking at a return in price action into this region, I'm looking for this 4-hour order block at 1720 to get mitigated, to get filled. All right. Now, if we move across the indices again fairly quickly, just trying to give us a kind of a broader synopsis of the markets this week. Of course, what have we seen? Well, we've seen this as we talked about Fed pivot over the last couple of weeks. Didn't deliver on Wednesday, massive sell-off, and the price action returns back into this 3700 level. Now, you'll see it here. We've got an unmitigated 4-hour level here at 36. Okay. You'll also see an unmitigated 4-hour level here at 3650. So I'm going to add those in as 4-hour levels. And of course, if you go to the 1-hour chart after this sell-off that we saw into Wednesday, you will see accumulation at this 37 level. Okay, so this impulse, this buying impulse here, which originated last Friday, in fact, okay, very, very clear. Actually, no, sorry, apologies. Friday of 2 weeks ago has been very, very clear in terms of, well, this is where an impulse started from. We've come all the way back down to mitigate this I suppose, area of interest here. Now, for me, from my perspective, I would have preferred to see the price action fill the whole move of the liquidity. And that's why I was less conscious of this level and more focused on this one myself personally. But that all comes down to, I suppose, a personal viewpoint, a personal approach on how you obviously look at entering into the markets. Now, when we look at the S&Ps, structurally speaking, from Wednesday, we had that massive, so we had that short-term structure up here, massive breakthrough. We had that massive impulse from 6 to 630, of course, off the initial FOMC meeting. Wick rejection, clear liquidity move, takes the short-term highs from Tuesday and, of course, from Wednesday day into the FOMC, takes the liquidity, completely sells off back into 700 level, should I say, this week. And I suppose that's now where we are. We've been seeing a lot of up and down movements in the indices now between 3,700 and, I suppose, for lack of a better word, this region here around 3,800. So we've broken through the short-term dead cat high bounces from Thursday. We broke through, we flagged back down again, and now we're closing close to those highs. So from my perspective, it's really just about how does the price action develop from this region into the early part of this week. And of course, if we see that weaker dollar, of course, that's going to mean stronger indices, and we should see an elevated return back into the upside. But of course, all eyes is going to really be on the sentiment into the early parts of this week, because when you look at the 4-hour structure, it's still holding underneath this, as I said, 3775, 3800 level. And of course, you can kind of see this price action level for those who are price action traders rather than liquidity traders. You can kind of see it there as well. There's a short-term area of interest. So worth keeping an eye on that. And of course, determining whether the price action continue this bullish trend. So we've got higher highs, higher lows, corrective structure. Can the price action now continue moving higher? Now, if you were to use short-term fibs from low to high, and looking at the most recent pullback and retracement, you will also see how we've rejected the discounted buying zone 707 to 786, and you can see how that's played out very, very cleanly. So now the 50 Fibonacci level is actually holding out as a short-term top. So if the price action closes above the 50 fib, the likelihood is you're going to see that as simulation to the upside, and price action is going to fulfill, or going to try and fulfill, those highs from the early parts of this week gone by, and also the potential to run up into some of these order block levels. So you've got this 4-hour structure here around about 39.50, but if I go up to the daily chart, you also have this massive daily order block area up here at around about 4065. So worth keeping an eye on that to see how does the markets develop in the early parts of this week. We could actually very easily roll over, fill some of these imbalances down here, and then look to move. That's also a scenario too. So it's just all about creating clear structure within the price action. Lastly, I suppose if we look at the Nasdaq and the Dow Jones before we finish up with Europe, again, Nasdaq structure, very, very clear rejection off this area of liquidity up here. As we said, at 11,650, 11,700, we had that initial sell-off last week into the highs of Monday and Tuesday of this week. And of course, then what happened? We had the complete rollover. Nasdaq has really suffered this week as we've come all the way back down into this liquidity area, which we saw from the CPI figure. Okay, what happened? This impulse from CPI, price action has come all the way back down into this region here. And if you draw a little just price action level, just to kind of illustrate that, you can see how it's playing out very, very cleanly. Okay. So I suppose that perspective is if we break through 10.6 into the early part of this week, the likelihood is you're going to see further selling and you're going to see further pressure here in the indices to the downside, particularly on the Nasdaq. All right. Dow Jones, on the other hand, is obviously quite interesting because the Dow Jones has done really, really well, because the stocks within the Dow Jones Industrial Index has actually performed a lot better than the tech stocks, like your traditional Google, your Apple, your Microsoft, your Amazon, all of those collective stocks as a nature. The Dow Jones performers have actually way outperformed. And of course, that's why you're seeing the Dow Jones up here at 32.5, 33,000 compared to the Nasdaq, which is actually sitting at those CPI lows. So in comparison to the Nasdaq, if you're comparing Nasdaq with Dow Jones, you'd actually see the Nasdaq is actually trading down here in relevance because it's trading at those CPI lows. Whereas obviously Dow Jones is far outperforming and therefore is far higher on the charts. Now, when you look at the Dow Jones, this is also something of interest. So if there is a reaction this week, then it's going to be off this 32,500 level, because you can kind of see here, right, we've come all the way back up into this daily 4-hour daily area. So if I go up to the daily chart for a second, you will see this daily order block area of interest just underneath 33,000. That was mitigated on Wednesday by the FOMC. If we dial down to the 4-hour chart, you'll see that peak formation. You'll see this short-term impulse to try and take out the liquidity stop hunt. We've broken structure, we've sold off, and you'll also see how the price action was returned back into this 4-hour structure. So from my perspective this week, it'll be all eyes to see, is there a kind of a runoff from this 32.5? Because if we do see the bears kicking in again in the indices and the stock markets, and we see dollar strength return, then you'd likely see it return from this region. So that is going to be one to kind of keep an eye on, this kind of 4-hour, 1-hour area of interest here. And you can actually see here that we've mitigated it already on Friday. Into the Friday's close, we tried to break through it, but we've ultimately failed. So that could be a telltale sign for the potential. And of course, if you look at the 15-minute charts, you can actually see there's one last 15-minute order block level here at around about 32,520 to keep an eye on. And that'll be worth keeping an eye on, as I said, Sunday into Monday. Now, that leaves us then finally with Europe, FTSE, and the DAX. And the DAX is completely surged through. So this, I suppose, area of interest that I was looking at on the DAX was this 4-hour level of interest here, order block level. We've come in, we've mitigated initially, we've come back into these lows around 13,000, 13,100, and the DAX is actually now surged through. So this area of liquidity has now been broken through. It's been cleaned out. The markets are trying to progress through. So that's a kind of an interesting sign. But you'll also notice in the DAX, this massive wick that's formed here on the middle of September, you'll actually notice how it hasn't broken through it. So there is still the potential for a turnaround here, but I would be watching this closely, because if it breaks through this wick, the likelihood is you're going to see DAX continue to trend higher, at which point then you're really looking at DAX coming back up into taking out this area of interest, taking out this level, as we said, removing all of this, and then looking at this potential 4-hour daily level here, as I said, between 13,830 to 13,950. This region of interest here really then becomes the focal point for price action. So daily perspective here, you've got the daily roadblock at 13,840. So I'm just going to put in daily, but you also have a 4-hour level of interest up here at 13,930. So this area of interest will be worth watching for those who trade maybe higher time frame analysis. But at this moment in time, it does look like the DAX trend is trying to continue pushing on, but it really just depends on whether it takes out the liquidity from this wick here. So that's what I would focus on this week on there. Last but not least then, as we finish up for the week, is the FTSE. So the FTSE has been on a massive rampage. So we had that we had that 6,800 low. So that 6,800 low that we've kind of talked about for multiple weeks now did initially break on the FOMC. But if you look at the price action since then, okay, we've returned back into 7,000. So this kind of 7,000 level, that's been another price action structure over the last 9-12 months or so. You can see how there's been a strong reaction. If you're a traditional retail trader, you would see, well, there's a double bottom. There's a wick rejection of the lows, price action stop punted, and it's now starting to create that impulse to the upside. That is a very, very clear telltale sign. Now, structurally speaking, from there, we've also broken through the short-term peak highs. So if you look at the shorter run price action between this trend of price action, let's say from mid-August to where we are now in November, we can see that there's been a sell-off. We can see that there's been a mitigation of this area of interest up here. And then we've seen the next run-off. We've seen very, very sharp selling from this 7,450, 7,500 level all the way back into the 6,800s where we created that stop hunt. And now we're seeing the price action simulate a bullish trend. So again, FTSE, you can kind of see how the dynamics here in the FTSE is slightly different to what's happening in the US. So it'll be worth keeping an eye on this because it does look like FTSE still has more to run here in comparison to the US. And of course, from my perspective now, it'll be a case of can the price action continue trending higher back up into this 4-hour roadblock up here, as I said, at around about 74.60. Now, when I look at the price action as well, you will also see in the short-term perspective, right? If I just kind of dial in on the 1-hour charts, you can see how the order flow has been quite clear as well. 1-hour charts, kind of short-term highs, short-term lows. So you can kind of see visually how the trend is grinding higher. It's kind of propelling to the upside until such a time where it's actually kind of broken through. So this short-term liquidity high from the early parts of October has been broken. We've made new short-term highs. And you will also see how the price action has returned back to that level. So if you're looking at the 1-hour charts from this impulse here where we've broken out of this region, you will see how the price action has gone from swing low to swing high. Price action is pulled back into the discounted orientation level, and then the price action then has made new short-term highs. You're in this kind of Fibonacci structure of discounted level, higher highs, higher lows, price action is trending higher. So from that perspective now, it just becomes a case of waiting, buying the dips, and then seeing can the higher time frame analysis get back into this 74.50, 74.65 level up here that we're kind of talking about on the 4-hour and daily charts. All right, so that's the kind of, I suppose, the week in the markets to round off the volatility over the last 4 or 5 days specifically, and of course gearing towards the next set of volatile fundamental events. So what we have next week, we've got CPI, and of course then with that as well, we're gearing towards the midterm elections at the back end of November. All right, have a great weekend, everyone. We'll see you all next week. Trade safe.